And welcome. It's Mary Ellen McGonagle here with your weekly MEM Edge show, the show where we bring you where the action is in the broader markets. So as usual, lots to cover after another bumpy ride for the week. Let's go ahead and take a look at our agenda today. As usual, we're going to start by taking a look at the broader markets. Just where did we close? What can we be on the lookout for going forward? And then, of course, from there, we will look behind the scenes. We want to see where relative strength may be illuminated, as well as where the weakness is continuing to take place. Also, earnings reports and management guiding higher. We are still in the throes of Q4 earnings season, and there are some themes that I did want to bring to your attention that are shaping up after this week. And then value versus growth. We'll take a close look there. Of course, there's been a rotation in place, and we'll dig deeper into that. Also, consumer staples, they are faring well this week, certainly in light and compared to other areas, they are up 1% relative to the broader markets down 1.5% to 2%, depending on that index. So we'll take a look at that, and then ways that you can short the markets as well. So two different areas. Before we begin that, let's take a look at some of the more impactful news this week. And of course, geopolitical tensions, and by far that was the biggest and had the largest impact on the broader markets this week. Russia and Ukraine, of course, as the markets anticipate, as well as certainly elsewhere, are anticipating some sort of action or conflict taking place over the near future. From there, we did get some reports. Wholesale prices did post their largest gain in a year. And that took place actually earlier in the week. And generally, the markets were able to shrug that off. And unfortunately, other as it relates to geopolitical and other tensions took over. So also Fed meeting notes from January meeting were released on Wednesday. And by and large, this was another report that the markets took in fairly good standing. They were less hawkish than investors had expected. So that was certainly good news. And then also retail sales and industrial production, both of those numbers came in fairly strong as it related to their January numbers. We like to see growth as that backdrop. And also next week, a nice holiday shortened week. I think we can all use a break on what we are seeing, but manufacturing PMI, that's going to be another inflation related report, as well as the core consumer price index. That's going to be a month over month number, to highly relatively important inflation reports that are going to be closely watched. Consumer sentiment is also going to be reported next week. That has been lagging in the face of high inflation. So investors will be keeping a close eye on that as well. So from here, let's go ahead and take a look at those broader markets, see where we did close for the week. And I am going to just take a second here to go ahead and pull up that chart. Here we are. This is a daily price chart of the S&P 500. And what we can see is that we did close the week back below that 200-day simple moving average. And in fact, quite similar to last week, where we had a nice rally into the middle of the week, into Wednesday. This is not last week, the prior week. And then into the end of the week, we closed that down below that 200-day simple moving average. That was all about one of the Fed officials' comments regarding an aggressive Fed in the way of raising rates spooked the markets. And then, of course, that Friday, the geopolitical concerns were highlighted. This week, we had rally on Monday and Tuesday into certainly Thursday and Friday. We did see deterioration, again, all about geopolitical, and the lack and the receding of geopolitical tensions in the beginning of the week allowed that rally to take place. So really that is dominating the tape as it relates to news that is moving the markets, but of course, other backdrops that are not so constructive. So let's take a look at some of these other indicators here. RSI trending downward below that 50, so we're in negative standing as we were last week as well. And the stochastics, they had been positive. This is a faster moving momentum indicator. Now they too are in negative territory below that 50 and trending lower. So very negative overall look here for the broader markets. I'm going to take us over here to a quick look at the weekly chart for the S&P 500 to provide a longer term view and outlook. So this blue line is a 50-week simple moving average. It's not something I normally follow. Normally I have a 40-week 200-day, but this 50-week was pointed out to me by colleagues over at Simpler Trading, and on the lookout for a break below that, which unfortunately we did close below that 50-week. But let's take a look at the outside momentum indicators. Also negative RSI, now at 42 below that 50, and stochastics are downward. So your intermediate longer term outlook for the S&P 500 also negative. Quick look here at the NASDAQ, tech heavy area, high growth, and we can see that the NASDAQ is not in good standing. I did see a headline earlier today, this red 50-day simple moving average crossing below that 200. That is a death cross, very much a secondary indicator. The last time it occurred was in 2020. However, if you see that headline, know that that 2020 period when it broke below this 200, it was just at the tail end of the bear market, a very different look. So rather than key in on that, I'm going to pay closer attention to these RSI and stochastic indicators, which are both in negative standing. And unfortunately, we are getting close to near-term support as the tech-heavy NASDAQ is under selling pressure. So from here, we can go ahead and take a look at those underlying sectors. This is a 2-month daily price chart view of those 11 S&P 500 sectors. I'm going to go ahead and update that because I have that RSI relative strength indicator as a filter. So up here in this upper left quartile are your relatively stronger areas, and then down below here, your weaker sectors. So first up, we can see energy remains up at the forefront. It was down this week, however, down 3.4%. Let me just go ahead and share with you a longer term monthly view, and you will see that we've had a very significant 2-month upward price move. So really any kind of consolidation at this juncture would not at all be out of line. In fact, would be constructive as this group potentially sets up. A lot of the bullish dynamics that are in place are still there. And of course, energy is a big key part of the Russia-Ukraine conflict as it relates to Russia and potentially the country sanctioning their exports to countries that do not agree if they were to be forceful against Ukraine. So this is certainly a centerpiece, energy and oil related stocks, but we'll get further into that as we move on. Consumer staples. Now, I did mention to you that the group is holding in well. It was up 1%, so very much unlike we just looked at the S&P and the NASDAQ, and this has an entirely different look. We are seeing higher lows, and it is reversing this downtrend. Now, of course, consumer staples are defensive. They provide products that are needed regardless of any economic backdrop, any geopolitical tensions. And I'm going to share with you a number of names, or a few names, I've narrowed it down, that are looking quite positive. Another factor here with staples stocks is they provide a yield, most of them, and that is constructive during periods of high inflation and rising interest rates. And we'll get into other factors there as it relates to those stocks. Financials were down. They did close the week and down 2%, but still up here in the forefront. And as we move forward, I will share with you that bank ETF because it was down, but less than the broader market. So from here, of course, I always want to take a look at technology, but really it's important, I would say, that you do as well. Tech is the largest part of that S&P 500 as far as of the broader markets, and technology sector is really looking quite similar to that NASDAQ as it relates to downside momentum indicators here, breaking below that 200-day simple moving average, and generally your moving average is trending downward. So you want to be aware of that. If you have holdings there, hopefully perhaps you've taken profits, but the near-term outlook remains negative here for technology. And then as we move on, XLV, healthcare, normally a defensive area, but it was down over 2% for the week, breaking below this 200. This next slide, I will provide more intel as it relates to the healthcare area. So let's go ahead and jump right over there. We are going to take a look further beyond these sectors and take a look at some of the ETFs that can really help you get your arms around what is taking place beneath the surface here. So again, a 2-month daily price chart view, that RSI relative strength indicator. I'm going to go ahead and update that. We had a little bit of a rally into the close today. So up here at the forefront, you gold bugs out there are going to know all about this. We did see a spike here in gold. Now, there are those that are looking at that as a safe haven play, and certainly that could very easily be a factor. But I will tell you, earnings are a big part as well. So we'll get into that as we move further. Brent crude up here in the forefront, it did pull back, but we are still at that 93 level per barrel, super elevated. This is very constructive, certainly for the oil producing stocks. And again, an area that has been really in an uptrending period, got into this overbought and is due at least a period of consolidation. But again, very elevated, quite constructive for those oil related stocks. Let's take a look at the volatility up here. Really, we did see some very big intraday swings. Today was options triple witching, which really bounced things around quite a bit. But we did recede from that 32 high that we saw earlier in the week, but we are still very elevated. We're up here at 28. From my work, anything above that 18 is indicating that sentiment is more fear related. That VIX is also known as the fear index. So from here, we can take a look at other areas that are relevant. Certainly the 10-year yield. This is the yield on the 10-year. It's very closely watched simply because higher interest rates do impact other areas, namely bank stocks, some of these financials. So we can see that the yield did drop going into the latter part of the week. A lot of that is investors, as they leave the equity markets, will often go to treasury bonds. Again, this is a safe haven area. As buyers come in, that yield does drop, but we are still at a relatively elevated level at that 1.9. So from here, we're going to take a quick look at that bank ETF. I mentioned that it was down less than the markets. We are bouncing around here. Just really, the banks are trying to find their way, but they do generally fare well in a rising interest rate environment, but definitely a lot in the way of wobbliness. Semiconductors, really dicey week. Take a look. We had lots of ups and downs, earnings. Uh, in case those of you that may not be familiar, the semiconductor group is being impacted by those geopolitical pressures because Ukraine, in particular, does provide some of the needed components for semiconductor manufacturing. So that is pushing that group down. I talked about healthcare not faring well this week. Here we are looking at the US Medical Devices ETF, IHI. It's one that I closely watch, mainly because when this group gets going, these are high growth medical related stocks that provide products, whether it's diabetes related and otherwise. But let's take a look. It was down 4% on the week, and there were stock companies in here that reported some good numbers, but those growth and certainly higher multiple factors are holding it back. So see if I can take a look. There was one other area, uh, and that is software stocks just cannot buy a break, down over 5% on the week. Another area where select companies are coming in with good numbers, but the market's just not having it. We are going back into a downtrending period, potentially getting below these previous lows here. So I'm going to take a brief break at this time, and when we get back, lots more to cover. Hi, this is Mary Ellen McGonagle, author of the MEM Edge Report. In my biweekly report, I highlight top growth stocks as they enter buy zones, and I educate subscribers on why that stock is attractive both technically and fundamentally. In addition, you'll be alerted to when it's time to exit that stock based on negative technical action. And this biweekly report gives you confidence by providing fundamental insights into why an area of the market is strong and which companies within that strong area have the best growth profiles that'll help propel that stock higher. Subscribers to the MEM Edge report are benefiting from my expertise in uncovering top performing growth stocks. Subscribe now to take advantage of my special trial offer. And we are back. Let's jump right in. I'm going to share with you some Vanguard ETF funds, value versus growth. I mentioned that we would take a look at that. This is VTV, the Vanguard Value ETF. Now, it doesn't look great, but when I pull up that growth, which is VUG, you'll certainly see a very clear-cut difference as it relates to those charts. The rotation out of growth that began as we saw the writing on the wall with interest rates beginning to rise. So what I'm going to do is share with you in that VTV ETF some of the top holdings in that value ETF just to have on your radar. And first up is Berkshire Hathaway, BRKB, holding up remarkably well. The company owns a lot of these consumer staples, higher yielding names. I've written about that you can go under the articles area and look up an article that I did about a month ago that talks about this conglomerate. Of course, Warren Buffett's company and some of the better looking names in this particular portfolio. From here, we can take a look at a couple of other stocks that are in this VTV top holdings. I reviewed the top holdings in that Vanguard Value ETF, and KO came up. It does have a 2.8% yield, and this is one of the names I had intended. I can certainly cover it now as it relates to consumer staples stocks. KO came out with their earnings this week. Good numbers, all about the ability to pass the inflation related higher cost on to consumers because of that brand loyalty, and the stock is hitting a new high in price. Let's take a look at another VTV stock, UNH. This is United Healthcare Group, and not holding up so spectacularly well. But for those that are chartist, and if we were at a better market, this would certainly be more appealing. But it is forming a cup with handle formation. We would need to see a break back above this 500 level before UNH turned positive. One other name on that VTV is XOM, and we can take a quick look. I talked to you about energy and oil related stocks, and we can see that it's pulling back with the group. The company does offer a 4.6% yield, which is attractive in the current environment, has a 15 times multiple, so the lower PE also is constructive. And the company did come out with earnings earlier this month. That's the spike here where they came in with their per share $2.05 per share. That compares to their fourth quarter in 2020, 3 cents per share. So huge boost going on there. So from here, let's take a look. I can certainly, no need to share that VUG growth is just filled with FANG stocks, Facebook, Amazon, Google, Tesla, and so on. So that is not faring well. The other citing is that VUG growth has an average PE, price to earnings ratio, of 38 times versus the value ETF VTV, which has a 18 times multiple. So that's being very closely watched by the markets. From here, I'm going to share with you some themes that are conceivably beginning to emerge as we get further into earnings season. So first up, I'm going to share a couple of stocks that report it. These are not great charts, but there is certainly something worth sharing. This is Bloomin' Brands, BLMN. For those of you that are in the restaurant space, I'm trying to think of the name of their restaurant, the Aussie. Oh my goodness. But more importantly, as it relates to today in this chart, we can see the big volume. They came out with numbers and 60 cents per share versus last year, 2 cents per share. So I'm going to share with you actually 3 restaurant stocks, and there is a theme here. The point is, I'm going to pull up a weekly on this stock. Uh, a lot of these restaurant stocks peaked back here and are now turning with these significantly higher earnings. And it's all about the really complete lockdown that had been taking place, was loosening up Q4 last year, and that in turn helped some of these guys come in with some pretty good numbers. Chewy, CHUY is another one, 40 cents versus their Q4 a year earlier was 20 cents per share, 111% year-over-year growth, 30% above estimates. So again, in the throes of that turnaround. Now, these are themes that are more for keeping them on your radar when the markets turn bullish, because we are seeing nice vibrancy in their earnings growth relative to the heavy lockdown period a year earlier. CAKE, another company that reported good numbers, 253% in the way of year-over-year growth. So from here, one other area I wanted to share with you that is reporting strong Q4 numbers, but guidance management is guiding higher for this year, and then other top characteristics as we look at these names. So here's Star Bulk Carriers Corp, SBLK. We can see a nice significant uptrend here. They did report their earnings this week. They came out with $2.96 $2.96 per share versus 30 cents last year. So super significant growth here. And this is all about these shipping stocks. What's happening here is that they have been able to increase their rates phenomenally. Normally, their average rates are about 4 to 6K per day. That's when these companies break even. And then over the last quarter, they were able to raise that to $37,000 per day. So really, they're coming in with these great numbers. This company has a 4 times multiple and a 14 times, a 14% yield. A couple of other shipping stocks, and then we can move on here. This is Zim Integrated, ZIM, and we can see that it's holding in well. It's not as dynamic as the other stock that we just viewed, but similar characteristics, 14% yield. It is trading at a 13 times multiple. So from here, let's take a look at one last name in this space, GOO. It's going to sound like Google, but it's GOGL is the ticker symbol. And we can see that it is also in a very confirmed uptrend, 461% year-over-year growth in their report. Actually, I'm showing a 20% yield. You may want to check on that, but equally low multiple. And then one last area that I did mention came in with good earnings, and it will tie in with that jump that we've seen in gold stocks. This is RGLD, big spike on numbers. The company reported 53% year-over-year growth. Actually, that's a different company, but they did show very strong growth. And we can take a look at other metal-related stocks. This is Barnes Group B. They did report 53% year-over-year growth, and they offer a 1.3% yield. We are seeing this kind of vibrancy in these commodity metal-related stocks. RS also came out with earnings this week, gap up for 240% year over year. Their multiple is at an 8x level. One last name, GFI, and this is Gold Fields. They also offer a nice 2% yield, 13 times PE, but nice uptrend here. This is more recent move is all about earnings as the stock enters into a confirmed uptrend. So last up, I did promise to share with you some of these consumer staples areas. I did write an article last Friday in Chart Watchers, and I talked about just this stock, Philip Morris. You can get more intel from there as to why, but they did report their earnings not this past week, but the prior week. Lots of growth dynamics taking place, super high yield there. But let's take a look at names that have reported this week. Not the prettiest of charts. I'll pull up a different daily view here. So this is Kellogg, ticker symbol K. They have a nice 3.5% yield, and the company reported on February 10th, and they had pretty good numbers. Not great, but that same concept of being able to pass their higher cost on to consumers. That's also taking place with this particular company. We can take a quick look at a stock that is due to report next week because a lot of these beverage, I talked about Coke. This is Dr. Pepper, KDP, and they are due to report next Thursday. So we can see a nice positive RSI. If we can get that black line up through the red, momentum indicator shift would not buy stocks into earnings. It has not in any way been a good play this earnings season. But next up here, we can take a look at Hershey, HSY, chocolate, of course, and they just reported their numbers and they are seeing record demand for their chocolates. Of course, they have the M&M brand, Kit Kat, and many others, and they're seeing a lot, again, in the way of high demand. They did report strong numbers. Their anticipated management guided higher as it relates to this year, continued growth. So we can see that RSI up here in positive standing. MACD kind of waffling around a bit, but it's certainly holding in well for those that need to be fully invested. And one last name, SJM. This is on my radar. My MEM Edge report did have the stock. We took it off as it began to deteriorate, but it could be turning. They're due to report their earnings pretty soon. I'm going to leave it there. Everyone have a great long weekend. And if you haven't already, use that link below. You can trial my MEM Edge report twice weekly at a very low rate. I'm going to keep you super updated on the markets, where we stand, what to be on the lookout for as it relates to this continued rotation. So take care. See you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.